Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for March 15th, 2021. Please share a disclaimer for important information. As we start off the week, we begin with our COVID tracker from the CDC, the information on our 7-day moving average of new daily cases and new daily deaths. And as you can see, we've had a slight uptick off the interim trough here on the 7-day new positive rate, but daily deaths continue to drop as we get further into the third month of the year. In our second slide, I wanted to show you the data that we're getting from covidtracking.com on current patients in the hospital and those also in the ICU, which is in that dark part of that line. You can see both of those are trending really nicely from our peak, our interim peak back in January, and so they continue to drop at a meaningful pace. This is data from the CDC that actually I kind of look at as a proxy for how well the vaccines are working, because the older folks are the ones that are being inoculated first. And this is actually data from long-term care facilities, cases and deaths by week. And as you see this data track from May of last year all the way through March of this year, you can see that trend line is pretty phenomenal. And we're actually down very, very close to the zero line in terms of new cases in long-term care facilities, which again, as I said, is where most of the people are being inoculated now, and a much greater percent of that particular population now has a vaccine. This is an update of the chart that we've showed you quite a few times now. And this week, we actually have the addition of Johnson & Johnson, which as of March 10th, there's a recorded almost 460,000 doses of the J&J vaccine have been administered. Now, otherwise, we're very, very close to 100 million total doses, and most of those are taken up by the Pfizer, BioNTech, and Moderna, which are 2-shot regimens, and obviously the J&J is only a 1-shot regimen, but we'll see the J&J percentage continue to rise as we move ahead and get more people inoculated. This is the trend line in 7-day moving average for inoculations, and just as we suspected there in February, we had that little bit of a dip, and a lot of that was weather related. We had the polar vortex, associated weather outages and closures that kind of caused us to lose a hair of momentum, but we've certainly regained that as we expected heading here into the middle of March. And trend line continues to look positive. We have a clear kind of weekly trend line, where we see those dips during the weekends, but then they pick back up rather strongly in midweek as we have more centers that are being used to mass inoculate people. They're using essentially football stadium parking lots and things like that. So should continue to see this trend line move higher and higher as we go further into the spring. This is a data set from the CDC as well as census as they're breaking it down into cohort. And this is the share of the people who've received at least one of those doses of the vaccine. And this kind of goes to my earlier slide on the nursing home and long-term care facilities where a much greater percentage of the over 75-year-old population has been inoculated, and then they're digging down into those layers and they're really focusing on the 65 on up now. And so as a percent of the total, we've got about 17.5% of the population that's had at least one vaccination. And now we've seen that the 50-year-old on up cohort is being opened up literally this week. So we're beginning to see, not only the 1As and 1Bs, but all the people that come after that, those windows being opened up as we get more vaccine supply from Johnson & Johnson, et cetera. I thought I'd show this. This is interesting. Came from to us from Charles Schwab from data from Bloomberg, but it just shows you by country, and the vaccination levels are clearly not consistent across countries. And what's interesting here is we don't have Israel in this, but Israel is really a world leader in terms of inoculating its population. And you can see here that US and UK are much further ahead than the EU is. They've been having all sorts of um, issues on logistics, and they also have a fairly severe bout of vaccine nationalism, where certain countries are refusing to ship product to other member countries in the EU until their own citizens are vaccinated, which, not surprising, we're doing some of that here in the US with our own manufacturing, which is part of the reason why our numbers are looking good relative to some of these other areas. But I show this slide. I just read a foreign affairs article that kind of speaks to this vaccine nationalism and the risk that we have additional problems coming from some of these new strains, and the new strains that are emanating from areas that have these lower vaccination rates could, continue to pose a problem, cause us to have to get booster shots and things like that. That we're not going to eradicate COVID-19 in its aggregate form for quite some time, and that until we get to kind of, herd immunity across the globe, we're still going to have to deal with these things. And as you can see here, even the developed nations within the EU are kind of struggling, relatively speaking, with vaccination rates. And then, of course, down below we've got China, which has a huge population, but as a percent of the total, clearly lagging behind some of the other areas. Here's our high frequency data from First Trust, and the data, as it always is a little bit mixed, but we're seeing more travel. We're seeing more of the economies open. And here in Texas, we went to 100% capacity as the governor rescinded the mask order. That certainly do encourage people along the line to continue wearing masks, especially if you've not been vaccinated, and our potential risk to others in carrying the virus and not knowing it. But you can see that more people are getting on the road. We're selling more gasoline, TSA checkpoint data, and as I mentioned, the restaurant industry, we've had some stronger data both in the last week as well as a trailing 1 month. We have had a little bit of pullback this last week in hotel RevPAR, revenue per available room, as well as daily rates and occupancy levels. But you can see the monthly data still looks really strong. And then in terms of production, we got rail car and steel production. Those numbers look really good, and we're beginning to see box offices at movie theaters open up, and so really strong data across the board, especially if you look at the trailing month, which is all green, which frankly we haven't really seen so far. So we're, again, by virtue of having more of these openings and more vaccinations, people are getting a little bit more confident in getting out and moving around. Here's our path to immunity, and we keep updating this on a weekly basis, but I want to make sure that I continue to explain the meaning of this chart. But in the blue down below represent the number of positive test cases, COVID-19 tests that have been administered. And the gray area represents the CDC's estimate that of every positive test case, that there are 4 cases that were positive in essentially people that had it and didn't know it. And then the green up above that represents the number of vaccinations. And as we posited back in even January talking about this, we knew that that green shaded area was going to continue to expand, and eventually it's going to overcome these other areas, and we're seeing that trend play out. So at least by data that compiled by First Trust from all these different government sources, this is just one estimate, and there are others out there, but that the trend line right now is that we have 60-ish% of the U.S. population that has antibodies. And there are some estimates from Johns Hopkins University that kind of puts that number maybe closer to 40%. There's some speculation, but clearly the trend line is moving higher as we get closer to herd immunity. All right, now we'll dig into some of the economic areas, and we've talked a lot recently about inflation. And what's interesting here in the data is the most recent inflation data that we've seen tells us that overall inflation is going up. This is consumer price inflation, CPI, and consumer price index, rather. And so on the left-hand side represents the all-in number, which does include food and energy. And we know energy prices have gone up, notwithstanding even the weather event. And we have a slide for that. But overall food and energy prices have gone up. So the overall CPI has moved higher. Now, if you strip those two categories out, what's really interesting is that we still struggle on the CPI side with year-over-year inflation. In fact, the estimate was for 1.4% positive growth in inflation year-over-year, and it actually came in slightly less than that. So, we've seen bouts of inflation on the consumer side as by this metric, and again, the Federal Reserve uses the Personal Consumption Expenditures, or PCE index, in their inflation assessments. But if you strip out food and energy and look at the core, we're still struggling to get out of the starting box. But clearly the expectations are building for future inflation in the pipeline. And to wit, here is some data from Bureau of Economic Analysis, the BEA, and a chart out of a Morgan Stanley research deck. And so this shows you the trend line in personal consumption expenditures, which I just mentioned, is what the Fed pays attention to. And you can look here and see as we get farther into 2021 that we anticipate that we're going to have higher PCE-based inflation, and then it's going to kind of coalesce, as we get maybe another 12 to 18 months down the road in something that looks more like 2.25%. And I think I've seen these types of estimates from different Federal Reserve branches, certainly from the San Francisco branch. I've seen this in this magnitude of increase coming out of the Dallas Fed, and they do their trimmed mean index, and also Cleveland Fed has some data which seems to corroborate this feeling that we're going to kind of pump up over 2%, but it's not going to be egregious, and it's not necessarily going to inspire the Fed to want to jump in and raise interest rates to control that. There's been a lot of speculation lately about the Fed, people feeling like the Fed needs to jump in and kind of control this recent jump in the 10-year interest rate, and I'm not exactly sure that needs to happen right now, and certainly I think the argument isn't very strong. If you're only going to have 2.3% and your target's 2, that's not a huge jump from where the target is, and I don't think that's going to move the needle as much on having the Fed, inspiring the Fed to move much higher on the short-term rate side. All right, well, what we've been talking about lately on the inflation topic has been some of these input costs, and I think these two charts kind of speak to that. On the left-hand side, we've got various raw material inputs on the food side, and also on textiles. We've got cotton, and then we've got wheat, corn, palm oil, and soybeans. You can see some of these dramatic increases dating back to the end of last June to the present. And in case of soybeans, we've seen a 60% price increase. Corn, we've seen a 45% price increase. And these are not to be taken lightly. When you think about corn and its various uses, so there's a lot of corn that goes into ethanol production. There's obviously a lot of corn that goes into many different food stocks, and then cotton in the textile business. its importance there is not to be understated. And so, these are all producer cost inputs that, as I've been saying, are high enough now that producers are less willing to absorb these hits to their operating margin and their profit margins, and they're more willing to begin to pass these along to consumers, which we've got some numbers from the National Federation of Independent Business, which definitely corroborate that feeling. On the right-hand side, we've got crude oil production. We know that we've seen oil prices move much higher. Some of it has to do with the OPEC Plus regime and how they've approached production. But here in the U.S., we've reattained essentially 11 million barrels a day. You can see that is a level that we last saw back in 2018, but 2019 we had a very strong rate of production increase, but we're pretty far away from that. We need essentially another 2 million barrels, or probably about 18% move in production from here to get back up to those levels. And I just don't see it happening very soon. We need to have sustained prices at $60 a barrel for a while to begin to bring some of this idle production back online. Here is that NFIB small business index. Now this is their interest in raising selling prices, and so I think this is very representative of what's going on in the production channel and the pressure that these businesses have to pass along these production cost increases out to the final consumer. So this, I think, is a very strong statement to the notion of expected inflation on the horizon. Again, this chart, looks fairly stark in its magnitude, but prices really dropped off the table last March and April. And so, but we not only have we caught back up on the index side, but we've also surpassed where we were in years prior. And so there's clearly an input here that we're going to have to pay attention to. But again, from an inflation standpoint, this is not unexpected inflation. This is not a huge negative surprise. It's something that you would typically expect as you head into an expansion cycle in the market. Kind of digging a little bit further into the National Federation of Independent Business indicators, small business outlook. We've talked a lot about that, not necessarily as much recently, but I think it's clear to say that we still have some issues on the small business side. Outlook is, I think, still mixed to negative on the small business side, and then optimism has been, low. I think, when we get more of these regional openings, like in Texas here, and you get more people vaccinated, these numbers will trend back up. But you're going to have, in the meantime, you're going to have small businesses that are just simply going to continue to go away and not come back. You're going to lose some business along the way. But over time, you're going to see these indicators pick up and eventually regain positive territory. Payroll and labor, and we're really, I think, struggling to come back in the labor market. Recent data has been more positive. We've got to continue to monitor this for progress. I think incremental gains from here might be a little bit more challenging, but on the top end side, I think we're going to continue to see payroll gains as we reopen, as businesses stabilize. First, they're going to want to stabilize their cash flow, especially small business, and then they're going to be looking for opportunities for growth. And once they begin to see tangible evidence that there is room for them to grow, then they'll start hiring. So the hiring will come at a little bit of a lag, and I think after what happened last year, a lot of small businesses are going to be reluctant to hire first in anticipation of that growth. They're going to want to make sure that that growth is out there for them. And but I do see positive trends, as that upper chart would indicate. On the lower chart, this represents kind of this estimate data from the Bureau of Labor Statistics, but again, Morgan Stanley, a large investment bank, this is their estimate. And I think from a trend line standpoint, it makes a lot of sense that we're going to continue to see that decline in the unemployment rate, but it's going to take a while for us to even have a whiff of where we were. And honestly, I think it's going to be another 18 months before we get within range of where we were. It might even be a little bit longer, but again, it could be a little bit sooner, just based on the pace at which people are vaccinated and the ability for our economy to reopen. Here's our S&P 500 index, and for all the noise in the market lately and the kind of the rotation out of tech stocks and maybe into some of the value and cyclical sectors, the overall index has continues to show strength and momentum. Here we are kind of testing resistance from February, basically. This is a very short-term interim number, but the glide path as we look back, into the latter part of 2020 has, on balance, been very positive. And so I still think that there's enough, noise and what have you. And certainly the impetus now is probably going to be on people wanting to make sure that they take profits before, while they can, and generate incremental liquidity. So the opportunity for us to see kind of these, short-term drop-offs here, and in this case, we're dealing with, if you go back to the end of January, we were essentially 3,900, not quite, 4,000, but then we dropped down to about 3,740. So that's, essentially 214, maybe 5%, a little bit less than 5% movement in both March and February. And I think those types of moves are certainly well within reason here coming up in the next month or so. Sentiment has been very strong. In fact, it's definitely in euphoric territory, and this is an indicator that Charles Schwab assembles. And essentially, what it's telling us here is that the market is very complacent, very confident. We're in the kind of this, euphoric area that we see from time to time. Eventually it does correct. It doesn't stay up here forever. It could oscillate quite a bit in euphoric territory, which I think in this case it probably will, because we've got, we just have the $1.9 trillion stimulus bill signed, so that's going to put a lot of money into the lower income part of our population, who we know will spend it, and so we'll get a benefit from that, and also the reopenings and vaccinations, so on and so forth. So I would expect this number to continue to remain high and kind of oscillate, not quite necessarily as high as it is now, but certainly in positive territory. I thought this was interesting that the stocks that, and this is not terribly surprising, but stocks that tend to be more interest rate and inflation sensitive, more so, are reacting much better in this environment where we have this buildup of expected inflation than we see in the other areas. And this is the inflation long index, and I just kind of highlight that the pink side of this is just there's a lot of momentum behind those inflation sensitive names in the market. And in this chart, we have data from Longview Economics as well as Macrobon. And the dotted line represents the S&P 500 price return. And we've talked about that. We just saw a chart of that here lately, but the solid black line represents periods of oversold and overbought conditions. And what's interesting, by their estimate here, that we only have essentially about 10% of the market is overbought at this point. And kind of their theory is that, we had very strong leadership in a small handful of tech names last year, and we saw the market kind of even out a little bit with greater and broader participation as part of the index, but we still have a large part of the index that is trading at more reasonable valuations than the market itself is. And so I think this is telling us here that while the index may be, and we'll see a chart here in a second on the cyclically adjusted price to earnings ratio in the market and how that is high, that the overall number of stocks or percent of stocks in the index itself are really not overbought. And I think that's an important distinction here as we look at this number that's telling us that really 10% of the market is overbought at this particular juncture. Here's margin debt. This is typically an indicator that you watch when the market seems frothy. This is for lack of a better term, these are individual investors that are taking on margin debt. They're basically borrowing money to buy stocks because they want to juice their return, thinking that the stocks are going to continue to go up. And you typically see margin debt really spike towards the tail end of a significant market move. And so not too surprisingly, we do see that. And that's in that red shaded part of this. And then you've got the S&P index year over year that's kind of superimposed on that. But clearly margin debt is much higher than we've seen it, even back in 2007 when we felt like, and certainly now analyzing it in retrospect, that the market was ahead of itself given what the fundamentals were telling us at the time, that margin debt right now is much higher than that. And that kind of goes back to the slide that we saw on pessimism and euphoria. The market is very euphoric right now, even though, as we just saw, a small part of the index is actually overbought in relative terms. But clearly, I think this would argue here for a little bit more volatility in the coming weeks. Now let's talk a little bit about the bond market. So here we have the 20-year Treasury bond ETF. So these are ETF prices that represent the kind of serve as the proxy for the 20-year Treasury. And we've seen these prices really drop off lately as interest rates have gone up. So essentially these two charts, the one on the left and right, are kind of telling a very similar story, even though they're different indicators per se. On the left, we've got that line rolling over, and that just means that as yields go up, prices go down. And you can see the rather dramatic move that we've seen in over a period of time. On the right-hand side, we've got the spread between the 2-year Treasury and the 10-year Treasury. And we know that short-term rates have been anchored because the Fed's interest in wanting to promote both its full employment mandate as well as stable price mandate. Right now, probably focusing more on full employment. And so the short-term rates are going to remain low for a while, but we know with this inflation pressure or this expectation building that longer-term rates are moving higher. And so as a result, we've seen a fairly dramatic amount of steepening in the yield curve. And that's evidenced on the right-hand side with that spread between the 10 and the 2-year Treasury moving much higher to levels that we haven't seen in several years. Again, just indicative of this new regime that we're watching unfold before us in the fixed income markets. And kind of to that end, we've talked a lot about inflation and building in the pipeline and the Fed's interest in wanting to maintain full employment. And they've told us in these meetings and the public statements after their Federal Open Market Committee meetings that, that they intend to basically let inflation run a little bit hot for a while. And so right now, what this chart tells us, this is the basically the forward chart that kind of indicates where the market believes the Fed is going to begin to raise rates. And right now, the pricing of this is suggesting that we're not going to see the first hike until the end of next year. And the second hike that we'll get probably in the second quarter of 2023. And obviously that things could evolve perhaps a little bit faster if we get this unexpected bout of inflation, which really drives rates materially higher. But at this point, we don't have the visibility on that taking place. This is the chart of the real 10-year yields. And so what's going on here is you have the nominal rate of interest on, or basically the nominal rate of yield on a 10-year treasury, and you're subtracting the inflation to get a real yield. And we saw certainly at the end of last year that maybe the inflation was beginning to perk up a little bit in the minds of investors, but we didn't see the movement in the 10-year treasury until here just recently. And so these, as inflation expectations built higher, and 10-year treasury rates remained fairly low, then you saw a pretty stout negative real yield. And now we're seeing a move in those yields, obviously moving higher, but inflation at the same time is moving higher. So we remain in a negative real yield standpoint, even though we're a little bit less negative than we were. And that just means that we're having a much faster, or relatively faster increase in 10-year treasury yields than we have in inflation. But I do think more inflation is coming. And so eventually we'll get back up to the break-even line on this as rates kind of move higher and normalize, which is generally, where they will always wind up, certainly above real yields above zero. But right now, this is just kind of an interesting environment because the market is having trouble focusing on where to allocate capital. Typically in a negative real yield situation like this, you'd see interest in gold, and oftentimes this kind of suggests that you've got lower overall interest rates, which isn't necessarily positive for the US dollar, but in this case we've seen recent strengthening in the dollar. We have a chart for you on that as well. And here is that chart on the US dollar. We've seen a weakening overall in 2020. And we've seen a bit of a strengthening here in 2021. And really, if you look at it on its face, it really has a lot to do with rates overall moving higher, that global rates remain really low. US dollar is a reserve currency. And so when US rates move higher, and they are relatively speaking more attractive than foreign yields, you tend to see more demand in the dollar, and you tend to see the dollar move higher, which is not necessarily good news for the commodity baskets, which a lot of which are priced in dollars. So a strong dollar is not as conducive for that. And but right now we can see this 200-day moving average is still on the wholesale negative. If you look back to basically about a year ago, and but recent strengthening may or may not hold. I don't see the case for the dollar really reversing all of its losses last year, and I expect overall US dollar kind of remain a little bit range bound over the next several months. I pulled this chart out of a presentation article I read in the Daily Shot. Actually, it wasn't an article, it was just a chart, but what was really compelling to me was with as much as we've been talking about U.S. savings rates moving really higher on the basis of U.S. stimulus, U.S. federal stimulus being accumulated on the margin, this is really not a U.S. problem. This is a global issue. And you look at all of these other countries here during the yellow shaded COVID-19 period, what is really telling here is that savings rates have gone up around the world. And as I've talked in these charts of the week and in the sister webcast to this, which is Market Minutes, about how this pent up liquidity on the sidelines is and should be good for growth as we look in the quarters ahead, that's not just a U.S. phenomenon. So as we keep talking about the prospects of a global synchronized recovery, looking at this chart, it's very clear to me that there's the feedstock and what I'll call the mother's milk of expansion staring us right in the face right here. These savings rates, um, and I think leave a lot of opportunity for the global economy as a whole to expand over the next 1 to 2 years. And I'll conclude on this slide. And if you live in Texas, it makes a lot of sense. But if you're looking, maybe in other areas of the country, maybe a little less so. But given that Texas, 90% of Texas power generation comes from ERCOT, the Electricity Reliability Council of Texas. And with our outages and whatnot, we saw some tremendous spikes in prices, which is represented in that green line, punching right through $1,400 per megawatt and megawatt hour, I should say. But you can see the normal seasonality and just the magnificent impact that the storms had on electrical prices across the grid here in Texas. Now, having said that, a lot of the local power distributors are not passing these exorbitant costs on to consumers, and they're taking a margin hit as a result. But for those few days that we have those rolling outages, the magnitude of the price increase at the spot level was really profound. Well, that will do it this week for Charts of the Week. Hope you've enjoyed the presentation. On behalf of all of my colleagues at BKA Wealth, it's a real pleasure to present these to you. We welcome your comments at the information you see here. Hope you have a safe week, a productive week, and we'll see you again very soon.